Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Stop the threats. China demands sincerity from the U.S. on trade talks. President Trump says a new tariff rate may be unveiled in just weeks. And a relief for the automakers. U.S. moles easing levies targeting car makers. And tech earnings in full swing. IBM fails to meet expectations. Alphabet, Intel, they're up next. So we take a break this morning from yesterday's bullish runs, which, by the way, was the first back-to-back gains of more than 1% since November 6th, the day after Trump's election victory. There was tariff relief. There was relief from talking about Powell, but China this morning is saying that they aren't currently in dialogue with the U.S., and they still want a change in rhetoric, so down we go on the stock market. S&P 500 futures down more than 0.5%, nearly 1% for NASDAQ 100 futures. The tariff relief also meant a rally for the Treasury market. That continues today. Yesterday was mostly the long end that saw the relief. Today, 10-year yields are down by 4 basis points, just about. Your 2-year yield also down by 4 basis points, too, even though it had been mostly curve flattening yesterday. 382 on your 2-year, 434 on your 10-year. All right, let's get a look at what's moving underneath the surface here with your stocks to watch. As always, is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So IBM really the one to watch in the pre-market today. Take a look where we are on this one. We're down around 8% in those early trading at the moment. The software business missing expectations, and pretty much all of the EPS growth at the company just coming from cost cutting rather than sales. But it's looking a bit more positive over in chips for Texas Instruments. The company actually reporting positive growth in the quarter for the first time in around 5 years, and setting the tone for some of those other tech earnings that you mentioned coming up later today, including Google and Intel. We've got NVIDIA on the screen, but take my word for it, Texas Instruments is actually positive this morning. Then finally, Americans not eating enough tacos or burritos, according to Chipotle, which downgrades its earnings forecast today. And that stock sliding around 4%. Chipotle Mexican Grill, disappointing. We need to eat more burritos, I think, Danny. And take a look at the Before the Bell opening wrap, where you'll get more of this news on the terminal
Joe,
today.
for what it's worth, I just want to say I've been doing my part. Maybe not Chipotle, but the tacos, burritos, you know, been doing it.
Doing your bit for the cause.
Every little bit helps. Joe, thank you so much. And by the way, Joe did mention Texas Instruments. Those shares are up 3.25%. We'll catch up with Joe later in the hour. And just in moments, we're going to be speaking to Ella Hoxha of Newton Investment Management. Later in the hour, we'll catch up with Garrett Melson of Natixis Advisors. Now, over the past 2 days, some of the market stress has begun to ease. The VIX closed yesterday at its lowest level since Liberation Day. High yield spreads also reached their tightest since April 2nd as well. And on the haven side, gold's rally, that took a breather, and the Swiss franc has given back some of its gains versus the dollar. Pleased to say that joining us now is Ella Hoxha, head of fixed income at Newton Investment Management. Ella, is there a sense, or is it too soon to say, that the most anxious part of this market, that the worst of it is over?
I think, judging by my sleep patterns, probably it's not over yet. And I think I'm sure I'm joined by a lot of market participants in that. No, I mean, look, we've had probably the first initial stage, the immediate correction, which was sharp, probably not followed as much by the rally in bond markets, particularly core bond markets, but certainly by weakness in credit markets. But I would probably say that's perhaps leg one of the move, which usually tends to be big, juicy, and followed by some correction, which we've seen. But I think we do have a further continuation of weakness in the months ahead of us. That's certainly what we're anticipating.
We've certainly had some people shift on not just this being a short-term thing, but a structural shift. And Ella, this comes from George Salovelos of Deutsche Bank just moments ago, putting out a new forecast saying that we are in a structural bear market for the dollar because you have a lessening of desire, for one example, of international investors to fund the twin deficit in the U.S. Are we talking about a change that's structural in America or short-term?
Well, I think the policy initiatives, even before we started this move in markets, were pointing to some appetite for a weaker dollar. I mean, the dollar's been very strong, particularly over the last 3 years. And so that was anticipated by markets, but probably thinking it's going to happen later this year. And so the speed of the move surprised, I think, many participants, including ourselves, but also how quickly it set off. Now, going forward, you can see from the way the dollar reacts, right? So the rallies are very short-lived and not large in magnitude, and the sell-offs have been pretty persistent. So there's a lot of momentum in that trade. And if you believe that there is a capital movement story here, then those capital movements tend to last or persist for long periods of time. I think the yen comes to mind, back in 2013 with Abenomics, right? So the weakness in the yen persisted for over a decade, so close to 12 years. So we could be perhaps in that sort of environment where you're looking at a multiple-year period of weakness in the dollar.
I just want to go back to what you started with that comment, that the speed of which has been surprising. And I think a lot of people pointed to hedge funds getting margin calls, different deleveraging trades that really fueled this, that sort of fast money acting. But of course, there are pension funds out there that in order to make decisions for what investments look like, they have the debate for months, maybe even half a year before they truly commit to different positioning. What happens when that real money starts to take a different view of American assets? Are we in risk for more losses when that starts to play?
I think so, yes. And the reason is, for example, some of the pension funds you're referring to would have seen big drawdowns over the last, let's say, 4 to 6 weeks, right? Because we had a major correction in market that was not followed by a big rally in bond markets, which would buffer some of those allocations. So had that flow happened, as you say, some of those meetings and decisions take months and typically tend to happen at quarter ends. They're not sort of like on the spot. Most of the moves we've seen were more likely to be hedge fund or active manager in nature. And so going forward, you can still have that larger, chunky, more sticky institutional money that still needs to allocate to different entities. And that's why I was saying earlier that this is a story that potentially has legs and could take much longer, rather, not even a few quarters, it could be years.
Well, it's the weird thing because we're talking about this longer term and how things play out. But in the very short term, Ella, it's tariffs on, it's an easing of rhetoric, it's stocks rally, it's stocks give back those rallies. What do you do in the here and now in that type of volatility?
Well, we were joking on the Feng Shui side, with the Chinese New Year and saying this is the year of the snake, and it's typically very volatile, right? So if you're into your Chinese astrology, but I mean, jokes aside, look, I think a very volatile environment. Very good for active management. So lots of opportunities for people like ourselves, to take bets and sort of move the portfolio around. So if you're dynamic in nature as an investor, this is actually pretty good. It's very good for macro. It's good for turning points, for calling cycles. So it's not all negative. And you can, it's been a challenging period for sure year to date for a lot of macro investors. But at the same time, lots of opportunities on the table. So we're actually excited, by the setup.
Where do you see the most opportunities in that, Ella?
Well, I mean, I think in fixed income space, you can still play for some widening in credit spreads, but, there are attractive yields available now. Certainly in the high yield universe, you're getting, wherever you can get 9% plus yields, you can lock those gains and expect decent return going forward. Of course, you have to pick carefully. Local emerging markets are very attractive. You're getting double-digit yields in a lot of places, earning a lot of carry. As we were saying, in currency space, there's opportunity away from some of the more traditional plays that we've seen. So some developed markets could rally significantly in the years ahead. And so, of course, and in core duration, you've had few backups this year already to be bought. So we've been buying this weakness recently in core rates, looking for bonds to actually rally on the next few quarters. So lots of attractive pockets, certainly in macro space.
By the way, Ella, I just want to mention that 2026 is the year of the horse. That still feels volatile to me. So I'm kind of thinking about like a bucking horse. So maybe this goes on for some time if you're checking your Chinese calendars. Ella, thank you so much for joining us. Ella Hoxha of Newton Investment Management. All right, let's get some other top stories that are trending this morning on the terminal. Now, speaking of assets fleeing the U.S., Japanese assets are set to draw record inflows. Another sign that funds are leaving the U.S. Data from Japan's finance ministry shows that overseas investors bought a net $67 billion worth of stocks and bonds so far in April. That's the most for the Japanese assets, with data going back to 1996. And Jane Street traders outperforming, vaulting past Bank of America and Citi last year. Documents seen by Bloomberg show that the firm generated a record $20.5 billion in net trading revenue in 2024. That's nearly double its haul from a year earlier. Jane Street said that it's also on track for a record first quarter for net trading revenue. And NVIDIA supplier SK Hynix warns it has become more challenging than ever to predict future market conditions. The South Korean firm sees increased volatility in the second half of the year due to the ongoing uncertainty surrounding U.S. tariffs. That's despite the company forecasting resilient demand for its AI memory chips. Coming up, Beijing tells Washington to scrap unilateral tariffs. More on that coming up next on your Bloomberg Brief.
How soon do you want to bring the tariffs on Chinese goods?
Well, that depends on them. If we just set the tariff, it's something that we think that will happen, I'd say, over the next couple of weeks. Wouldn't you say? I think so. Over the next 2-3 weeks. China has been judging us massive tariffs for many years.
President Trump hinting at a potential new tariff rate for China. Meanwhile, Treasury Secretary Scott Bessent said that there has been no unilateral offer to take down U.S. tariffs on China. He spoke at the IIF about a possible deal.
If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, I think they use the term dual circulation. Right. Well, right now it's really singular circulation. And if they want to rebalance, let's do it together.
And Chinese officials responding just hours ago. The Ministry of Commerce spokesman saying, quote, China and the U.S. are not in talks on tariff, and the U.S. needs to show sincerity if it wants to talk. The U.S. should revoke all unilateral tariffs on China if it wants to solve problems, which, by the way, Scott Bessent explicitly said that the U.S. would not do. Joining us now is Bloomberg's Brendan Murray. Brendan, we have to start with exactly where we started yesterday. Is the U.S. negotiating with someone or with itself on Chinese tariffs?
Yeah, I mean, it doesn't seem that there's any negotiation going on with the Chinese at the moment. It was just a couple days ago that President Trump said the ball is in China's court. Well, China has now come back and said, okay, you want to sit down and talk, you're going to have to remove those tariffs that add up to about 145%. Those are causing a lot of economic dislocations in China, and those reverberations are going to roll back onto the U.S. economy in a couple of weeks. If you listen to some people in the logistics industry talk about how basically trade between the U.S. and China has been shut off, and there will be things like shortages on shelves and production lines that are going to have to shut down. So I think what we're seeing is not only the change in the tone of the rhetoric, but the shift in the leverage. China is now saying, if you want to talk to us, you have to remove those tariffs, and so we'll see how the White House responds to a pretty specific ask from Beijing.
And Trump himself saying that if we don't reach a deal, we're going to set the level, which begs the question, what was April 2nd for, if not setting the levels? But there was that Wall Street Journal scoop, Brendan, saying that the China level could be somewhere between 50 and 65%, which I have to say sounds a lot like Trump's campaign promise. Are we going to end up just back in that place of 10% universal tariffs and 60% on China, as the Trump administration promised?
Yeah, we'll see if that's enough to bring China to any sort of talks about a trade deal. 50 or 60% is still a very high tariff that will cause a lot of problems for not only Chinese exporters but American importers. So that's still something that will cause that will be a growth headwind. It will cause upward pressure on inflation. Obviously, not as much as the 145% now, but we'll see if that's something that China can live with. But as far as the comments that they made today, it sounds like they're drawing a pretty firm line and saying the only way we're going to start talking is if you remove those tariffs.
Well, it seems like in terms of getting some tariffs removed or at least eased, the auto manufacturing industry has broken through. What do we know about possible changes there, Brendan?
Yeah, this is one of the industries that will be has gotten a reprieve already to some extent, but there are going to be tariffs that kick in early May on auto parts. So the supply chains across North America are very integrated. North America acts as almost one economy when it comes to automobile production, and the president has announced that he's going to be in Michigan next week for his 100-day anniversary and celebrating that milestone with automakers. So presumably they're in line to get another reprieve, some more relief from tariffs that are bearing down on an industry that Trump considers vital to the U.S. economy.
Hey, Brendan, just quickly, I think it's always interesting to come back to Japan and where talks are, because the administration said if you come to us early, we'll make a deal with you, and Japan was one of those countries. Has there been any movement since talks with the country began?
It sounds like they're headed in the right direction, and Japan is certainly out in front of a lot of other countries. If the U.S. can't make a trade deal with Japan, then it's going to be tough for them to do any deal with any other country, because there already is a fairly mature trading relationship established there. But it depends on how you define deal. Is a deal just some vague commitments to purchase more LNG or rice or these kinds of things that are written on an executive order that may change with the next administration, or an actual trade deal with lawyers and legally binding commitments? It depends on how serious they are about what the definition of a deal is as to how quickly they could sign something.
Yeah, I can't believe we're in the territory of talking about what the definition of a deal is. Brendan, thank you so much for joining us this morning. We really always appreciate it. Bloomberg's Brendan Murray. Okay, coming up, shares of IBM sinking in the pre-market trade, failing to meet high expectations, off just over 7.5%. Plus, we're also going to push ahead to more tech earnings from Alphabet and Intel. You're watching Bloomberg Brief. Let's take a look on what is on the front pages this morning. First up, the New York Times having President Trump's falling approval rating. It sunk to 45%. It shedded 7 percentage points since taking office. Around half of the country now says that it disapproves of his performance. Next up, the Washington Post has this, that Defense Secretary Pete Hegseth had the Signal messaging app installed on his office computer at the Pentagon. That also follows reports from the New York Times on Sunday of a second Signal group chat that included his wife and brother, where details about a Yemen operation were shared. Finally, on the Wall Street Journal, Russia's biggest strike on Kyiv this year, killing 9 and injuring 70. The strike follows President Trump lashing out at Ukrainian President Vladimir Zelensky for failing to accept the U.S. peace proposal. Now let's get back to earnings, because IBM shares, let's get a check on them. They are dropping sharply in the pre-market trade. Or actually, they're higher now. That is surprising. They were literally just down moments ago. Shows you the volatility of this world. But that's after the company failed to meet expectations or hopes. I'm going to check in on that. Despite posting a beat in the first quarter results, let's bring in Robert Lee, senior tech analyst for Bloomberg Intelligence, who joins us now. Robert, first, just let me get your take on IBM. What was your read on the results, which I should say something was wrong with that pre-market board we showed. They are down 7.7%.
Okay, well, I was going to say the only certainty in this market is uncertainty and volatility, isn't it? So it's either a trader's dream or a trader's nightmare. But back to IBM, yeah, it was a decent beat, 13% ahead at the EPS level, mainly driven by cost savings and operational efficiencies. But most importantly, they reaffirmed their guidance for 2025. And given this very uncertain environment, I mean, that has to be a good thing. I think there were a few worries going into the results as well, and the management sort of successfully gave some comfort on that. So, for example, they have exposure to the US federal budget. With the cuts ongoing there at the moment, they confirmed that they should remain relatively unscathed. And my US colleague thinks that their exposure on the federal side is only about 1% of their revenue, so it's not particularly large. And then there's the issue of tariffs. And they also confirmed that the incoming spend is around 5% of their total spend. So again, their exposure to tariffs is relatively limited. But then the question is, why is the stock down? And there's a good reason for that. So that's quite a rhetorical question, or shall I carry on?
Yeah, carry on, Robert. Why is it down?
Yeah, sorry. Well, I think the thing is, ultimately, business consulting is a major part of their revenue, and that is a discretionary activity, isn't it? Businesses don't have to spend on consulting. Maybe it's relating to a deal or a transaction, but all of these have a high degree of sensitivity to the economic cycle. So whilst we've yet to see any significant impact on, GDP, GDP forecasts for the year in the US and elsewhere are being brought down for obvious reasons. So I think in the second half, if we do go into an economic slowdown or, we encounter more difficulties on the macro front, then IBM is a business exposed to that. And I think that is the main area of sensitivity and perhaps why the stock is down.
Hey, Robert, I hate to do this to you because we have less than a minute, but just quickly, Google after the bell, what do you expect?
Okay, Google's driven by the Gen AI spend, so startups in the US increasingly adopt their latest generation of model, Gemini 2.5. That should help drive that and their cloud business. YouTube ads search is all holding up, so overall I think expectations are quite strong going in. And then also, as you know, I think Thursday we've got Intel, so we'll have to wait and see what the new CEO says in terms of the new strategy and potential for cost cuts. I just want to give a shout out to one of our colleagues in Taipei who, put a story out a couple of days ago on the terminal. Perhaps Intel could be announcing up to 20,000 reduction in their headcount. So we'll have to see what is said on that front.
Lots of headlines, even before the
points.
earnings are coming out. Robert, thank you so much. Robert Lee there, Bloomberg Intelligence. Coming up, buy the dip, sell the rips. That's the view from Garrett Melson of Natixis. That's next. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Stop the threats. China demands sincerity from the U.S. on trade talks. President Trump says a new tariff rate may be unveiled in just weeks. A relief for autos. U.S. officials mull easing levies targeting car makers. And tech earnings in full swing. IBM fails to meet expectations. Alphabet, Intel, they're up next. Will that relief rally to back-to-back 1% plus gains, which, by the way, was the first time we've had that since November 6th, takes a breather this morning. We're lower by more than 0.5% for your S&P. For the NASDAQ 100 futures session, off 0.8%, but we're off of the lows that we had. China, as I mentioned, saying that the negotiations are not happening. Maybe that's adding to some of the dour move. But that tariff relief and Powell talk relief that we had yesterday also led us to a bond market rally. That continues in earnest this morning. It was the long end yesterday. The front end starts to cooperate this morning. So we are seeing yields move lower, even though you're not currently looking at your Treasury market on your screen. There you go. We're lower by 3.5 basis points for your 10-year yield at 4.34. For your 2-year yield, it is 4.5 basis points at 30.82. Let's get a look at the stocks moving underneath the surface. Back with us is Bloomberg's Joe Easton. Hey, Joe.
So IBM now significantly lower, heading towards the open, down around 8%, almost 7.7% in the pre-market. Now, the earnings weren't actually too bad, but bear in mind this stock had rallied by around a third over the past year, and actually a little bit of softness coming into the software business, and also the top end of the estimates, probably a little bit disappointing on that one. Then Texas Instruments doing a bit of a heavy lifting in the pre-market in terms of the chips. The guidance there actually better than most analysts expected, and actually returning to growth in the latest quarter for the first time in several years for Texas. So a decent one on that, ahead of all those big tech earnings coming up later. And then a 2-for-1 on the airlines. Southwest and Alaska both dropping. They are saying that Americans are cutting back on their spending on air travel, not just Chipotle. So airlines are weaker. We're seeing Southwest and Alaska both down significantly. Alaska down 6.6%. Airlines probably going to be weak. American Airlines coming up later as well. Keep an eye on that one in a few hours' time, Danny.
Yep, some real weakness that these companies are talking about in the consumer. Joe, thank you so much. Bloomberg's Joe Easton, excellent work as always. Now, in terms of this overall market, Garrett Melson of Natixis is looking at some near-term risks in markets, writing, quote, "The uncertainty overhang is likely to remain for some time, and that means we could see that protracted tug of war continue to play out in markets in the form of buy the dips and sell the rips. type of action. Joining us now, I'm pleased to say, is Garrett, portfolio strategist at Natixis Advisors. Garrett, really great to see you this morning. And look, that's just so of the moment, because we're in this feedback loop where it feels like tariffs on, you back off in tariffs, markets rally, markets sell off. It's a carousel that we're struggling to get off of. So what do you do while we're on this ride?
Yeah, it's a really challenging environment. I think that really highlights the struggle, I think, that's going to continue to play out both for markets, but the real economy. I mean, we all know just how much this uncertainty is weighing on confidence from consumers, investors, business leaders. That all has an effect on the real economic activity. And the longer that continues, the longer those drags continue to mount. And as that translates back to the markets, I mean, you can see that playing out in these volatile swings from day to day. You have one official roll out and talk about softening, and then you have maybe the same official or another one walking back some of that and firming up some of that language. And so I think that just speaks to the fact that this is going to be continuing for some time, even if we do see some de-escalation, which is obviously the market's hope and seems to be the path that we're on here. I think this is going to continue to be an issue that weighs on sentiment. So at the lows, you certainly are pricing in quite a bit of damage in it, to an extent, even maybe a mild recession. But until you have really that cloud of uncertainty lifting, it's hard to get too aggressive pushing that. And I think that just sets up for a pretty wide range trade for the foreseeable future.
Well, Garrett, you have been writing since the pause that wide range has gotten a little bit more narrow, that the left tail was flattened and severed. It's an important distinction between what's going on with markets now and how we see the economic environment versus before that 90-day pause. Does that mean, even though we see this volatility, that the lowest of lows are in?
Yeah, it's hard to say for sure. You know, I think the big issue post-Liberation Day was that left tail was very wide open. We just simply didn't know what the end goal for the administration was. But if it was really to restructure trade and basically level out that trade deficit, that would be a very, very painful process. And frankly, one that would be almost impossible to do. You know, I think we have seen that really isn't necessarily the end goal. And we've kind of gotten back to this idea of tariffs as a negotiating tactic. But the problem is we don't really know what the clear demands are. And that can still translate to a pretty painful and protracted period of negotiations. So if we do actually settle into a recession, which, you know, is not necessarily the base case, if we get a de-escalation soon enough, I think you could probably be left with an environment, maybe that's not an outright recession, but it certainly is going to be a backdrop of pretty tepid growth for at least the next couple of quarters here. But if we do have a little bit more of an aggressive pullback in economic activity, if these persist at current rates, then, you know, you may have to price in a little bit more. But the bottom line, I think, is clear, is you've done quite a bit of damage pricing in a recession, which is probably more likely to be an income statement recession, one where, you know, incomes are still pretty decent. They slow and margins maybe compress and earnings compress, but certainly not a deep and drawn out recession like the post-financial crisis. And if that's what we're looking at, then you may have pretty good argument to start dipping your toe into more risk as you push back towards those 4,800 lows.
Garrett, part of the volatility has also come from just who's speaking. And you were kind of hinting at this, but there was a great study from Neil Dutta at RedMac that looked at S&P 500 performance on days where either Bessent, Lutnick, or Navarro were in the news. And as you could imagine, the S&P has lost a total of 719 points on days when Lutnick and Navarro have been in the news. When Bessent is in the news, the S&P has gone up by a total of 52 points. It's this weird environment where, Garrett, you, as a market participant, almost have to also become a political commentator. So for the market at this point, how important is it that Scott Bessent is driving the narrative?
Yeah, I think it's pretty important. You know, it was a little bit frustrating to see his voice kind of pushed down at the early stages of this post-Liberation Day trend here. But I think you are clearly seeing some themes and evidence, you know, especially in the anecdotes, that he's gaining more leverage and having a little bit more sway in the administration. I think he certainly is trying to push that idea of escalate to de-escalate. Now, maybe that's just kind of trying to clean up the mess in the wake of Liberation Day, but clearly he seems to have a more tempered approach on the trade front and seems to be trying to feel the market, as Trump always likes to do. And so to the degree that he continues to have a little bit more sway in the administration, I think that's helpful. But the risk is you continue to see, you know, markets price in optimism of a near-term de-escalation, and then ultimately those hopes get dashed, and you see this kind of continuation of this merry-go-round of hopes, and then hopes being smashed here, and again setting up that pretty wide range trade.
Yeah, again, and then as you've been pointing to, what damage is done in the short term. And I know when it comes to fixed income, Garrett, you've been also looking overseas. It's a conversation that we've been having where bond yields haven't really moved or had the same recovery that equity markets have had in some of this relief. Is there a structural shift? Are you viewing it as such that overseas bond markets become more attractive and treasuries less so?
Yeah, this is a debate we're having quite a bit. I think you could probably make the argument that it's a bull market in the death of U.S. exceptionalism. I think that might be a little bit too far, but certainly the sheen has come off. I think that's a hard case to make on the equity front when you just consider how much of this is of global growth continues to be driven by the tech sector, which dominates the U.S. markets, and the resilience in margins, stronger ROIs. So I think that story is intact, even if the sheen's come off. But on the fixed income side, all of that uncertainty, all of that volatility in policy ultimately translates to a risk premium that I think needs to be baked into yields. And I think that's keeping the longer end more elevated than it otherwise would be. When you look across the ocean, though, they're not dealing with tension in the dual mandate, right? They're dealing with downside risk to growth as opposed to upside risk to inflation and downside to risk to growth as the Fed is dealing with. And I think that leads to a better backdrop where they have more fiscal headroom, they have more monetary space to ease as they can really focus in on downside risk to growth. And that, I think, means you have this near-term environment where you might actually have better opportunity to see that real safe haven activity in global sovereigns as opposed into the U.S. I don't think that's necessarily a durable regime shift, but certainly an opportunity in the near term.
Hey, Garrett, this has been so excellent. Thanks for taking a break on the merry-go-round to talk with us. Please join again soon. Garrett Melson of Natixis Advisors. You're watching Bloomberg.
How soon do you want to bring the tariffs on Chinese goods?
Well, that depends on them. If we just set the tariff, it's something that we think that will happen, I'd say, over the next couple of weeks. Wouldn't you say? I think so. Over the next 2-3 weeks. China has been judging us massive tariffs for many years.
President Trump weighing a possible new tariff rate for China. Meanwhile, Treasury Secretary Scott Bessent spoke at the IIF about a possible deal despite no offer to cut tariffs.
If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, I think they use the term dual circulation. Right. Well, right now it's really singular circulation. And if they want to rebalance, let's do it together.
And Beijing just responding hours ago with the Ministry of Commerce spokesman saying, quote, China and the U.S. are not in talks on tariffs, and the U.S. needs to show sincerity if it wants to talk. The U.S. should revoke all unilateral tariffs on China if it wants to solve problems. Joining us now is Bloomberg's Joshua Galou. Josh, is the U.S. not negotiating with China at this point? Is it simply negotiating with itself?
Well, it sounds like there are a lot of public statements coming out that they're trying to use to move the needle a little bit and open up for dialogue. But as you said today, China said very clearly that there are no talks ongoing, and they've already laid out their demands for even entering into talks. They want the U.S. to show more respect and stop with the aggressive language about them ripping off the United States and being bad actors in all of this. They also want a point person that hasn't been sort of assigned, and they want some more consistency out of the U.S. It does look like, if you compare the language that Donald Trump has used over the last couple of weeks, from when they first instituted the tariffs to this week, things have changed dramatically, even though there aren't apparently any actual talks happening or changes in tariffs. So, the rates are still up around as high as 145%. And Trump this week, I guess 2 days ago, began talking about being very nice to China and things will go well if they sit down to talk. And sort of, the rest of the administration is talking about how 90 other countries have been approaching them about discussions, which is, unsurprising given the level of tariffs that they imposed on everyone. So right now it appears that things aren't moving forward, and China has taken a much stronger approach than perhaps the administration had expected.
Well, and it might be a change, but it might be changed back to his campaign promise, with the Journal reporting that the level for China could be somewhere between 50 and 65%. Josh, we also had some reporting on auto tariffs. Does it look like relief is coming for the sector?
It looks like it's at least under consideration here. Trump has indicated that as recently as yesterday that he doesn't plan to, knock down those tariffs. But at the same time, we've learned that officials are talking over different options for softening the blow, one of which is to fully exempt auto parts that are compliant with the U.S.-Mexico-Canada agreement. Because supply chains are so deeply integrated across North America and beyond, that it would, companies are being very clear with the administration that this would, the plan would cost massive amounts of money to the companies, or it would likely result in production cuts, job cuts, all of these things the administration obviously wants to avoid, particularly in places like Michigan, around Detroit. So, I think we've seen already that the administration has put a very high entry point on these tariffs and is also willing to come down. The question will be how they try and finesse that, because right now the tariffs as they stand it's universal across the car industry that it's going to be very painful, and also for consumers looking to buy a car, it's going to cost a lot more.
Yeah, again, reports of sort of that front loading to try to get out ahead of them and get out and buy a car. Josh, thank you so much for joining us. That is Bloomberg's Josh Gallo. Now let's get a check on IBM shares in the pre-market, falling more than 7%, nearly 8% now. The company failed to meet investor hopes despite posting a beat in the first quarter. Let's bring in back in Robert Lee, senior tech analyst for Bloomberg Intelligence. Robert, on the surface, numbers look great. First quarter sales increased 1% to $14.5 billion. Profit also exceeds expectations. So why are we looking at shares performing so poorly in the pre-market session?
Okay, I think the main answer to that is the outlook into the second half. And whilst the company reaffirmed its guidance for the full year, which is obviously a positive, the core of their business, or a substantial part of their business, is consulting, which is a discretionary item. Companies are not forced to spend. Maybe their consulting contracts they're taking on are related to deals. All of this is very highly economically sensitive. So I think as a result of the tariffs and what else is going on or emanating from the White House at the moment, if that ultimately drives a slowdown in economic activity into the second half, there is a risk that impacts the consulting business of IBM. I think there still were, a number of good positives in there, but they were widely anticipated. So it's the uncertainty on the second half outlook, I think, is pulling the shares back in the pre-market here.
Robert, I realize they're completely different businesses, but we're also going to hear from Google after the close as well. And in terms of the cyclical part of the business, whether it be advertising or willingness for companies to spend on the cloud, is that at risk this quarter?
I think, again, and this is a general comment for most tech businesses, including those here, depending on who they are and where they sit in the food chain, most companies have reasonable visibility on the second quarter and maybe into the first part of the third quarter. But again, we've got these uncertainties on the second half of the year because of the macro uncertainty, tariff uncertainty. And I think particularly with Google, obviously AI has been a major driver of its business. Again, near-term outlook, Gen AI outlook still remains positive. But as you have probably reported on yourself, I think a US broker came out with a story, I think even this week, that maybe Amazon was pulling back on some of its data center rental. And if you remember, 3 or 4 weeks ago, we had another US broker saying something similar with Microsoft. Because the biggest issue, the elephant in the room when it comes to Gen AI at the moment is monetization. Because if we did a straw poll of viewers here at the moment, I'm sure a percentage are paying for these Gen AI tools, but most of them are available for free, particularly in this part of the world. So if you look in the China context, the market's awash with free products. So if companies can't monetize, how can they generate a return on investment when they're spending tens of billions of dollars per year on CapEx? So I think these are key issues for here in China, and also, a similar question for the likes of Alphabet. So we'll see. But I think near term, the outlook for Alphabet looks pretty solid.
Yeah, we didn't even talk about the lawsuits coming for Alphabet. So many moving parts, Robert. We could do this all day. Thank you so much for joining us. Unfortunately, that's all we have time for. Robert Lee in Hong Kong. Now, some consumer earnings also out this morning in Europe. Both Unilever and Nestle seeing boosts in sales due to price increases. For more, let's bring in Bloomberg's Charlie Wells. Charlie, are we back in this environment where companies are finding excuses to raise prices? It feels like it's got some echoes of 2020.
Yeah, Danny, it's really interesting. I mean, consumers are sort of saying that they're not feeling great, but at least in the bathroom and in the chocolate aisle, they're willing to pay a little bit more than they had previously, because we have seen, Unilever get a boost from some of these premium products, particularly in the kind of personal care department. That's what we saw in earnings that they reported just earlier today. And also Nestle reporting a boost from being able to pass on some of the higher costs that they've been seeing on chocolate, on coffee. But as you mentioned, this is something of a double-edged sword, because this can really help companies boost earnings, at least for a while, until the consumer starts to push back. And both of these companies had seen a little bit of pushback, particularly in those years when we saw spiking inflation as consumers started to trend down. So for now, a positive story, at least on these earnings releases, but they've got to tread carefully.
Charlie, it does feel just really uneven in this moment. For example, we had earlier in the week earnings from Capital One, who said consumers are still solidly in the game. Kimberly-Clark talking about their ability to continue to spend. Amex looked good. And then we get Chipotle showing some weakness, a company that had been so strong. What did we hear from them? What are we understanding about what the consumer actually looks like?
This just speaks to the fact that we're still trying to get a read on kind of the difference between sentiment and hard data. And I think it's such a different story with Chipotle, where for the first time in almost 5 years, they saw a decrease in quarterly sales. This as consumers are pulling back on, I guess, what might be kind of that discretionary, fast, casual eating out that they may do when they feel a little bit more confident. And what was really striking here, aside from that decline, were comments that the CFO made after this earnings release. They did a survey, and they found that more than anything else, consumers of Chipotle were worried about what's next. So they're certainly taking into context what's happening in the economy and shifting that into how they're making their restaurant decisions. Now, Chipotle said they don't plan to raise prices, unlike a lot of these other businesses, but they're in that difficult category where, the consumer's being a lot more discretionary, at least with eating out.
What's next? I mean, why ruin a perfectly good burrito? Why we got to get crazy here? Charlie, thank you so much for joining. Bloomberg's Charlie Wells is shaking his head at me. I would do the same. Okay, coming up, more earnings on deck. We'll lay it out for you in your day ahead. This is Bloomberg. Let's get you set up for your day on this Thursday. We're going to get earnings from Pepsi, P&G, Merck, and Bristol-Myers. All those come before the bell. We'll also have initial jobless claims at 8:30 a.m. Eastern. That gets followed by existing home sales at 10 a.m. And then more earnings. Alphabet, Intel, all of them report their results after the market close. Let's look at some stocks on the moves this morning. IBM falling more than 7.5%. Yes, earnings beat, but results in their look forward failed to fully ease investor concerns. Texas Instruments, you can see that gaining 6.33%, a rosy outlook as demand rebounds. ServiceNow, that is up 9.33%, jumping after an outlook that signaled resilient software demand. All right, as we head to the end of the hour, let's take a look at overall markets. The rebound of yesterday takes a breather, which, by the way, we had our first back-to-back gains of more than 1% for the first time since the day after Trump's election. The dollar resumes its weakness. George Servalis over at Deutsche Bank saying we are entering a structural downshift in the U.S. dollar. All right, that is it for your brief this morning. Surveillance up next.